traders, Raghi here. Let's kick off this conversation with a look at gold that I mentioned in the free video and also in the closing session that I'm looking for a potential near-term short. So let's get with some specifics on what I'm looking for. Now, I am not longer-term bearish. This is really just an expectation that if we get a little bit more strength, preferably into about 1588 on April gold, that we could see this move head back down, take back some of today's pretty significant rally. I guess the first question is, why the rally? And think about what's happening. You know, what's going to light the fire under gold? And this really is a larger conversation about the four market trends of Dow theory that are the cornerstone of my wave, my 34 EMA wave, and grab candles. These were designed for me as a very young trader to decode the wisdom that I knew that was in Dow theory, and the idea that there are four market trends, not two. Remember, most of the market participants look at the market as if we're either in an uptrend or a downtrend, and there's nothing in between. Now, Charles Dow, well over a century ago, said no, there's four market trends. Yes, there's an uptrend, and yes, there's a downtrend, but there's a quiet, what's known as accumulation phase or trend, and there's also a distribution phase or trend. And without acknowledging the two sideways markets, most traders are perpetually either full bullish or full bearish without acknowledging that there are these sort of neutral markets that will carry with them the psychology of the preceding trend. It's almost like if you're on your bicycle and you could coast, what do? Well, if you're pedaling really hard and you stop pedaling, do you stop and go in the other direction? Of course not. You might be decelerating because you're no longer actively pedaling any longer, but you're still going to be going in that direction. And that applies to the markets as well. So Charles Dow would say you hang on to the trend until it ends, but he really didn't give us that much more to go off of. So what we acknowledge is that a broken uptrend is immediately distribution. A broken trend is immediately chop. Now this one's pretty intense because the movement lower in gold coincided those limit down panic days in the equities markets, which is not something historically we would talk about, but it is very much a part of what we saw in '08, which is as margin calls were going out, hedge funds, traders, whatever, they liquidated gold to meet those margin calls. They liquidated gold to meet capital requirements. They needed money, they liquidated gold. And that's why you'll see why I say many times gold is not a flight to safety currency or flight to safety metal. It actually behaves like a currency. It's not a flight to safety. That's one of the biggest misunderstandings of gold out there. It's a response. It's a way to look at real yields, and it moves inverse to real yields. And we've had conversations about this in previous sessions. And what I want to do is wait for gold to maybe give us a little bit more move to the upside, just a little bit more. And then into that little bit of strength tomorrow, maybe kind of a narrow body candle, we can buy some puts, not a lot in gold. Of course, I can do nothing, and that's fine too, and wait for the market to come back down to the bottom of the range. And that bottom of the range is coinciding really nicely with the our Z score, right here, our V score, which is a Z score of the volume weighted average price, right here, our V score, hitting zero. Okay, so looking at that culmination, so some of you might wonder, well, Rog, what if we were up at 2, a reading of 2? That would be great. That would tell me we're 2 standard deviations away from 0. And you look at what 2 standard deviations has meant in the past, and it's been a really good spot at which the market starts to snap back towards the 0 or our mean. So if that's what we're looking at, that'd be great. I would have had 0 hesitation today had we been up at that second standard deviation, plus 2. But we're not. So I'm going to wait for a little bit more to work with. And this 50% is the 50% retracement from this high to this low, or what I call the last major move. Okay? All right. So that's gold. And if I do, by the way, send out an alert or trade this, I will send out an alert on it. Those of you that grabbed the bond trade with the alert that we sent out on the 17th, this was the alert from the 17th. If you're a new member, this is actually a really good reminder that when I send out alerts, they could be a half a day, a week in advance of the ultimate criteria being met, the criteria that I will outline in the alert. And so this is what I'm doing for myself. I'm giving myself a number of criteria that need to be met. When they're met, the setup then becomes a trade. So my setup is what? If this happens and this happens and this price and this reading at this time, whatever it is, once that criteria is met, setup becomes trade entry. And so that criteria I will often know pretty well in advance. I want you then to also know well in advance what my criteria is. It gives you a chance to learn. It gives you a chance to prepare. And I don't want you taking these alerts as sort of knee-jerk get in, get out without ever understanding or preparing for what the risk might be or the different ways you can trade it. In this case, some traders could play the underlying futures contract. Some traders could play the TLT. You could play options on either. So giving you that kind of shelf life and heads up, a trade that's better for just this second, that's shelf life, and giving you a heads up, meaning more than right now, is very important to me. Hitting 180 is our first target, but I think we could keep going higher. And if we trade back down into the wave and towards the, this 34 EMA wave and towards the 55 exponential prop dots, then we might have another entry. And that could very well coincide with a +1 here on our V-score. All right, moving on to the currencies. You know that I want to buy the US dollar, and we have a very specific list to do so. Not having a specific list would ignore one of the most basic tenets of Forex trading, which is know your contrast. Look, I'm kind of very happy in some ways that even a little bit of US dollar weakness was hardly enough to budge the Aussie US dollar, New Zealand dollar, US dollar. In other words, yeah, the US dollar was kind of weak today, but hardly weak enough to outpace the weakness of the Australian and New Zealand dollars. That's why we like those particular currencies. That's what contrast does. Even when one of our main driver currencies, in this case US dollar and US dollar strength, more specifically, even when that wanes some, the other side of the pair, in this case the Australian dollar weakness, makes up for that. That's why these trends move so well. But on the flip side of that, if you're waiting to get in, it's a little frustrating because, well, when you have really good contrast, you're not going to have that many opportunities. Pound US is another currency we want to be shorting pound, buying US dollars, and US dollar, Canadian dollar. Again, we want to buy US dollars, short Canadian. Aussie US, New Zealand dollar US, and pound are all shorts. US dollar, Canadian dollar on the Forex side is a buy. Why? It's the order in which the US dollar is listed in the pair. Same idea, buy US dollars, but the direction of the trade is going to change based on whether or not the US dollar is the first currency, as it is here, then it's a directional play on the US dollar, or if it's the second currency like it is in the pound US, as you can see here, then it's a directional play on the pound, right? Whatever the first currency is, that's the directional play. All right, so those are the best 4 places to buy US dollars. So we'll keep our eye on that. And by the way, except for the New Zealand dollar, US dollar, you can look at FXA, FXC, or the British pound FXB, or you can play the futures contracts. Whenever the US dollar is in play, you will have liquid, viable futures alternatives to trade. All right, moving on then to, one of the biggest questions is, Rob, we know you want to short a bounce in the broader averages. How much of a bounce? we need a fairly significant rally. I want to see a higher high. I want to see one of those rips higher. Maybe that's going to be on the approval of this next stimulus bill. Maybe. I don't know. I'll have to wait. But the higher the rip, the more confident I am going to be about the short. Now, what do I mean by that? The higher the rip. In other words, the more the market overreacts to the upside, the lower the risk for two reasons. One, I really want to see this market have one of those rip-roaring days to the upside. A lot of bullishness and a lot of, delusion, quite frankly. I don't mean to be cheering on the move lower, but I'm a trader. I'm not going to have the bias of an investor. And I am an investor, but I can't carry with me the bias into my trades. The fact of the matter is, the closer we get to the 34 EMA wave, the happier I am, the higher the bounce, the better the trade, the lower the risk. There's just so much to be able to take advantage of with that high bounce. And that's going to pretty much apply to all four of our broader indices. That's going to apply to the the NASDAQ, the S&P, the Dow, the Russell. And any rip higher, by the way, in the U.S. markets, if I see echoed across international markets. EWG, EWA, EWS, Singapore, by the way, EWS, EWH, Hong Kong. I'm just kind of rattling through these really quick, but anywhere where I can see that sort of global sort of relief rally, if you will, that's going to be tremendous opportunity for us, gang. So heads up, keep those names front and center. And I shared this link in the notes that I shared with you all. So I did share my Monday session notes. I sent those out this morning. One of the links in a pretty beefy set of notes was right here, the iShares literature on the different currency ETFs. Some of them have viable options, some of them don't, but there are ways to play these, and I definitely want to when given the opportunity. I don't know that I'll be able to play the INDA, the India ETF. You can see that one lower pretty significantly because expectations are that the entire subcontinent is going to be in basically lockdown. And you can see the way in which INDA, the MSCI iShares of India responded on that news. So that one I may not get another shot at, but all of these I will look for opportunities. All right. Especially when they have the knock-on effect clearly of what's been happening with the coronavirus. I mean, that's just the way these markets are moving right now. So there's a great line from A Few Good Men, which is one of my favorite movies. Excellent screenplay. Aaron Sorkin screenplay, actually. And there's a scene where Kevin Bacon, he's one of the prosecutors, for those of you who've seen the movie, he's one of the prosecuting attorneys for the against Tom Cruise. And he says, I represent my client without